Barely 2 years post-IPO, WeWork Incorporated, once a trailblazer in the real estate sector, succumbed to bankruptcy, failing to transform its vision of dynamic workplaces into a sustainable business. The journey was a dramatic one for the startup that was initially valued at $47 billion. The bankruptcy filing disclosed $19 billion in debts against $15 billion in assets under Chapter 11 protection, permitting WeWork to remain operational while it seeks to stabilize its finances. As part of its restructuring strategy, WeWork has agreed with key investor SoftBank Group Corp and other creditors to cut its debts by over $3 billion, a move that is likely to leave most of its shareholders with nothing. As a publicly listed entity, WeWork has never been profitable, accruing losses totaling $3 billion. The question is why? What went wrong in a company that captured the imagination of investors from Wall Street Journal to Silicon Valley, with a founder who had pledged to revolutionize the white-collar workplace and foster community? This was supposed to be the future of work, away from the drab cubicle life, with vibrant spaces equipped with amenities like beer taps and recreational areas. Was it the business model? Was it the market? Was it the leadership? It may be a combination of all, but the one that made the biggest impact is the one that started it all, Ada Newman. Newmans Insider dealings. In March of 2018, The Real Deal reported that Newman had purchased a 50% stake in 88 University Place alongside fashion designer Eli Tahari. That property was then leased by WeWork, which then leased space within the building to IBM. The publication Wall Street Journal discovered that 88 University Place isn't alone. Newman also personally invested in properties in San Jose that were leased to WeWork as a tenant or are earmarked for such a purpose. Newman was invested in the 2 San Jose properties as part of a real estate consortium and owns a smaller stake of an unspecified percentage. These transactions were all disclosed in the company's prospectus documents it filed as part of its $700 million bond sale in April of 2018. According to the prospectus, WeWork's total future rents on these properties, partially owned by Newman, are $110.8 million as of December 2017. That doesn't include the reported $65 million purchase of a Chelsea property by Newman and partners, which is said to be earmarked for a new We Live space built from the ground up. That too will be subject to rent payments from the We company to run We Live out of it. Newman was both the landlord and the renter. Newman was borrowing money from WeWork too. In 2016, Newman borrowed $7 million from WeWork at a generous annual interest rate of 0.64%. Newman paid it back early in November 2017 with about $100,000 in interest. It was one of several times Newman borrowed company money. Newman took out a much bigger loan from WeWork a few months ago. The company lent him $362 million in April at 2.89% interest to help him exercise options to buy stock. By August, Newman repaid the debt by surrendering the shares back to the company. It's not clear from the filing why these transactions happened. Newman's control. The next logical question is, how did Newman get away with it? Newman had been able to maintain control of WeWork because the Class B and Class C shares he owned each had 20 votes to every 1 vote regular shareholders would get for their Class A shares. After a wave of criticism, WeWork amended its S-1 and limited Newman's super voting shares to 10 votes for every 1 regular share's voting power, still a high ratio. Bloomberg reported that following his resignation, Newman's shares were worth 3 votes. As part of the bailout, We stock now all has the same voting power, the Wall Street Journal reports, saying Newman's stake in the company will decline to below 10%. With the previous multi-class stock, it would have been hard to get rid of Newman if he didn't want to leave, since his super votes still gave him the power to fire the entire board. But if Newman did get rid of his opponents on the board, he would have run the risk of making WeWork look even more chaotic than it already was in the eyes of investors, threatening the outcome of an IPO. Original company filings stated that if he died, his wife Rebecca, the co-founder and the chief brand and impact officer of WeWork, would have been charged with appointing a successor. The updates to WeWork's S1 changed that Game of Thrones scenario to one in which the WeWork board would be responsible for finding the next CEO in the event of Newman's death. Newman's board supremacy allowed him to enact a number of non-standard financial practices that many have viewed as a conflict of interest. It was never profitable. It's no secret that WeWork was a money-losing business. It lost $1.6 billion on $1.8 billion in revenue last year. But that's par for the course when it comes to technology startups, which WeWork has tried really hard to convince the world that it is. Its ability to burn money sure makes it seem like a tech company, even if it doesn't have other important tech company qualities like low growth costs and a network effect, meaning the value of its product increases when more people use it. The company's expectations have changed even since its initial IPO filings in August. The company's updated S1 in September got rid of numerous references to break even, profitability, and cash flow, suggesting these goals are further off than expected. And WeWork's operating losses, what's left after the costs to bring in revenue, are marching in lockstep with its growing revenue. This means that the more money WeWork makes, the more it loses. Ideally, you'd want to see the opposite, shrinking losses as the company gains more revenue. The biggest expense, 65% of its revenue, is renting office space, which makes sense for a real estate company, but not for a tech company where you'd want to be able to rely on saving as you grow. Of course, much of WeWork's losses can be attributed to its breakneck speed of growth. Opening up new locations is expensive and it can take time to see returns. Presumably, if WeWork stopped expanding, it would curtail its losses, but even that is difficult to know since WeWork hasn't explained how profitable or not its established locations are. As the Financial Times wrote in August, instead of a neat profit and loss table for mature and growth locations, WeWork calculates a contribution margin, the metric formerly known as Community Adjusted EBITDA, earnings before interest, tax, depreciation, and amortization. Like any adjusted financial metric, it's designed to say to investors, ignore these costs because they don't matter to our core economics. What we do know is that WeWork has lots of debt, including a $702 million bond that's due in 2025, whose price has fallen in the wake of the recent company turmoil. The company also needs a lot more money, and raising it is becoming more and more difficult as its valuation declines. All these problems made one thing inevitable: WeWork's downfall and Newman's ousting. WeWork downfall. The company's trajectory took a drastic turn in 2019 from gearing up for an IPO to massive layoffs and a multi-billion-dollar rescue from SoftBank, which also took a reputational hit from its investment. After Newman stepped down, more traditionally minded managers were appointed. WeWork eventually merged with a special purpose acquisition company, SPAC, to go public in 2021, but this did not stem the financial bleeding. In early 2023, debt restructuring seemed promising, but did not prevent further problems. By August, WeWork expressed significant doubts about its ongoing viability. Now, with a restructuring plan supported by creditors holding 92% of its secured notes, WeWork aims to streamline its office space portfolio, according to a company statement. WeWork's struggles reflect a broader trend with other shared workspace firms like Knotel Inc. and IWG PLC's subsidiaries also filing for bankruptcy post-pandemic, an era that has transformed work habits significantly. But WeWork distinguished itself with its unique office environments and a notorious hard partying culture. Its best times featured extravagant summer parties with abundant beer and high-profile music acts. The company even ventured into living spaces with WeLive and education with WeGrow, a private elementary school. Other eclectic investments included an SEO company, a superfood startup, and a wave pool manufacturer. These ambitious projects, however, rapidly drained funds and investor confidence waned when WeWork attempted its IPO in 2019. Newman out. Sandeep Mathrani, a seasoned real estate executive, took the helm as CEO in an attempt to save the company, restructuring leases and trying to launch new products. But the challenge of achieving profitability, especially as the pandemic emptied WeWork spaces, proved insurmountable. With Tully now in charge as of May, WeWork will navigate its restructuring. The company plans to file for reorganization in Canada as well, though its operations in other regions will not be included in the bankruptcy proceedings. WeWork intends to continue serving its members, vendors, and partners during this period. According to a senior economist at Moody's Analytics, WeWork's downfall was due partially to the universal challenges that the pandemic posed to office space providers, but its unique management and unconventional operational strategies were also significant contributors to its financial demise. The bankruptcy is WeWork Inc. 23-19865, U.S. Bankruptcy Court for the District of New Jersey, Newark.